So Strayer Education is a for-profit school, and the whole sector has just been decimated. I mean, it's one of the worst performing, that's a great place to look, right? Whatever's not performing well. And so we have a very high management criteria. So when we went in looking at that sector initially, the CEOs at the other companies deserve their reputations. But Strayer stood out because Bob Silberman, who's their CEO, to me, it's the best shareholder letter I've ever read. It is, one, he starts off by telling you, this is how we make money. This is, very simply, he explains to you in the most simplistic terms what his business is about, where his revenue sources are. 70% comes from federal aid, 20% comes from corporate, where a corporation pays for a student to attend the school, 10% comes from, their own pocket. And he's just, and then we pay teacher salaries and to have, and then for us to administer the company. But when we were reading his shareholder letter, he was talking about the problems they had, such as, back then it was about not letting any student in. So we saw discipline. He was very disciplined and not, like for example, he used to criticize the practices of the other for-profit schools that's got them all in trouble right now, which is they would pay sales commissions to their recruiters, on the number of students they brought in. And so you'd hear, and surprisingly, Kaplan, owned by Washington Post, was one of the worst, where they were taking bums off the street and enrolling them in the college to get the federal, money. And Strayer doesn't pay commissions to its recruiters. They're paid a straight salary. They've never done that. Second thing we saw with Strayer is that they actually have two dual structures. So basically they have the academic side. So they manage it. It's almost like they have the academic side, they have the profit side. And so the academic side makes decisions on what is important from the academic standpoint. Because what will happen is there'll be a class that's not profitable, but it's very important for the education of that student. And so the academic side says this is a required class, but if it was the profit side making the decision, they'd say, absolutely not. We're not going to be investing in this. So for example, Strayer has invested in making sure that their new students have good math standards and writing standards, and so they invest in tutoring, to bring students up to speed. But we saw this discipline, and we're seeing it today. As the stock has been dropping, it's now trading for about 5 times enterprise value to cash flow or free cash flow, which is just a crazy valuation. But they have a lot of headwinds, and so we like to see it. We like Bob Silberman. And we like the model. The school, it's a high return on capital business. Today they're earning 20% operating margins, and that's worst case. The other thing is they're living their worst case scenario. Basically, they've had a big drop in the number of students. They've gone from 55,000 to, I think it's 46,000 today. And it's a high fixed cost business, so little changes in the revenue have profound impacts on the bottom line. So that their earnings, they were supposed to earn $11 or $12 a share today, and they're earning $5.50. It dropped earnings by half. But the value came where we saw that, initially we started buying because the government went after the industry. They were basically clamping down on their practices. And for some reason the government the schools don't have the same, they don't report the same numbers, such as retention. In other words, if they report a student retention, the way each school calculates it is completely different. So there's no standardized system. And Strayer kind of got caught as one of the worst companies, by these new standards. The government said that you have to meet these standards to get Title IV loans, which is basically, and so that's why the stock first started going down. And then you had these fundamental issues where you've had these high levels of unemployment, what they call real unemployment, and that has contributed to this decrease in demand. So, we kept buying this stock from over 100, now it's down to 45, and bought some today, in fact. And so we just keep buying it on its way down, just because we believe these issues are cyclical and that they will turn. And just like the drops in revenue had a big profound effect on the bottom line, that when things start improving, they're going to multiply. The other thing is that Silberman is actually a very good capital allocator because he's removed from the day-to-day operations of the business. So one thing that's interesting about capital allocation is if you are an operator of a business, CEO, I have found that all operators are not good capital allocators. I mean, you're really judging the degree of incompetence. as far as capital allocation, because the best capital allocators were moved from day to day. They're like Warren Buffett. There's a book called The Outsiders that's recent that Buffett recommended. The key theme is all these people. Henry Singleton worked alone in an office. Tom Murphy, they were not involved in day-to-day operations. So at STRA, actually, Silverman is now executive chairman and is not involved in the day-to-day, decision making on the courses that are offered. And so he sees a big picture. So while we're in this downturn, he's been buying back stock. He bought 5% this last quarter, 5% the previous quarter. In the last 3 years, they've taken it from 14 million shares to about 10.8 million shares today. So he's been very active in taking advantage of this low stock price. So we see that as kind of as a bottom, and that he's creating value for us on that end. But the most important thing is that he will not budge on on the student he admits. So they're very strict about the type of student they admit. One, they have to have a high school education. The other schools, they now are forced to use that, but he's always had that criteria. And they also have to pass some remedial standards. And it's very tempting for a CEO to lower the standards when you're losing so many students to fill the class. And he will not budge on this one thing. He says it's got to be the student we're looking for that fits best, because he, as he's explained, one bad student ruins a class. And anybody who's been in college knows that, that's true. You get a couple of bad students in the classroom, it really could ruin the course. They get combated with the professor, and it's a distraction. And so he's very, very disciplined in making sure that his university has a high quality student, because to him, as he says, the quality of his customer determines the value of that school. If he's graduating the wrong people, then that's not going to build value over the long term. And so these are the actions that we've got very interested in the company. Furthermore, it's got a lot of growth prospects. They're only halfway through their nationwide expansion plan. And what's interesting in the way they expand is one of the most disciplined growth companies, because what they do is they wait to see how many academic or deans they have available to open a campus. So first they see what is their human talent that's available. Then once they ascertain how many people can open campuses, that's what determines their growth rate. So if we have 5 deans that can open up college, and people that are under them, academic advisors and so forth, then they'll open that number of campuses. If it's 10, they'll open 10. And they also grow organically, geographically. So they're not going from New York, say, to California. They're growing state by state, because they like to borrow people from the closest geography to them. And so this way there's less execution issues, because say you have issues in your college in Texas, well, you can take people from Louisiana to kind of help that have been in this, maybe operating their school for 3 or 4 years, and then you've got new people in Texas. They borrow from those people, so it's a more discipline. So for us, we see, this is cyclical. The stock is super cheap, and we're basing our free cash flows on today's free cash flows, which are distressed free cash flows. These would not be your normalized, and so that's why we're buying with more conviction. Now, the biggest risk is the length of time it takes for the employment picture to improve and for the number of students to start enrolling again. The longer it takes, the longer it's going to take, for those earnings to come back. And so, that's basically what we see as the biggest risk. But we sleep well at night knowing we're partnered with that type of management that's going to be making the right long-term decisions, making these great capital allocation decisions. I mean, I can see them buying at least 30% of the stock over the next couple of years easily. And that'll, when things turn, it's going to have that double whammy of, increased earnings but off a lower share base. And so we're just patiently waiting. And just as long as we see that they're not sacrificing academic quality, to try to get more students in, or we're looking for those variables, that's very important to us, then we're comfortable in the investment.